I ask that you give me 15 seconds because there's a 15-second delay in order to bring on my screen and move away and migrate away from Don's screen. And we'll get the program running today. There we go. So here we are. I'm going to kick it off. Good morning and welcome to the second hour of TheoTRADE. I am Professor Jeffrey Bierman. I am broadcasting you live from Chicago, 22 degrees today, 22 degrees, bitterly cold. It was actually about 10 degrees overnight. And today is Monday. It is December 2nd. It is 2024. Good morning, TheoTRADE members. I hope all of you had a wonderful weekend and a wonderful Thanksgiving with your family. Now, with that said, okay, I'm going to kick off what we are going to talk about today. So this is the new format. So the new format is going to be as such. Today's coaching session, categories volatility. I've said this many a time. I say it every time I come on, so I'm like a broken record. 11 categories in my personal archive. I rotate constantly, refreshing, it's stimulating, it's value added. I don't stay on one topic. I'm not, the one trick pony like Tony or Corey, but they are great at what they do. I tend to be a jack of all trades. So today we're going to go down the volatility path. There's no better time to talk about volatility. You know why? Because there ain't any. And you and I know when there's no volatility, it's right around the corner. And when it comes, it's so unexpected, it usually fries people. It catches them by surprise. So I want you to be in touch with volatility. But this is a unique situation. It's not really as much a coaching session technically or fundamentally as it is strategic. So this will be part two. I did part one on Wednesday. So I want to remind you, I did part one on Wednesday. Thursday, obviously, we had the day off. Friday, we did an abbreviated session, Don and I together playing off each other. This one was from Wednesday. It's part two. It's a three-part series. This one's called Prepare for Takeoff. I could have said Prepare for Liftoff. Esoteric Volatility Facts and Rules, part two. So it's a little bit of strategy. It's a little bit of volatility. You can integrate them, combine them. It's both. We talked about 16 unbelievable facts about market volatility that took up the entire session on Wednesday. We'll kick it off with stock market halts and how it impacts volatility. But in the meantime, let me give you my take on the market. Now, every single instructor has a different model, has a different thesis, has different perspectives. It's not that one's better than the other or one's wrong, right. We're all right. We're all right. It just that depends how you look at the market. Now, I have my own set of rules, and this is my rule. It's not like anybody's at Theo, okay? Except perhaps Gianni. I never short on the way up. That's why I don't get killed. And I don't know how much higher this is going. I don't even want to go there. 60,000, it's at an all-time high right now. 6,100. I just don't care. Okay. The number doesn't matter to me. It may matter to a lot of you. It doesn't matter to me. It's irrelevant. Most important thing are the slopes. So I'm going to get in and talk about the slopes in just a minute, but I want to give you some color on what's driving the market today. The fact of the matter is this, okay? This is what I call titling today, Holiday Spirits Aplenty. Clearly, the market wants to go higher. And I'm not going to be one to step in its way, okay? And it's being guided primarily by tech, but there's other things afoot. The first thing I want to point out is you can never be in this business without knowing seasonality. The markets are always rigged. They're always manipulated. And sometimes they're manipulated higher and sometimes they're taken lower. Good news is coming out. Why am I down 25? Shut up. Quiet. It's down because of seasonality. It's down because the algos have grabbed it. They're killing it. They're running it. And there's nothing you can do about it, so stop complaining. Okay? We're going up. It's Cyber Monday. I call it the Cyber Monday call, as in a call option. It's like a call option. The market's bid higher out of the gate. Technology ran with it. End of story. We're not likely to fall today. So you can trade it intraday, and Corey will show, oh, it's a sideways day, it's a channel day. Well, I don't care. We're not going to go that much higher. We're not going to go that much lower. We're in the window dressing performance gaming. You're in it right now. The year-end performance gaming kicks in. Now, it started kicking in 2 weeks ago, but when it really starts to accelerate is December 1st. So today is the most obvious day of the entire year. I wake up, All my 52-week lows are lower, and all the 52-week highs are either coming down or going higher. It's that bifurcation. It's chase the winners and sell losers. This is tax loss harvesting kicking in today. Today, any stock that you own at or near a 52-week low, I guarantee, I'll bet my entire account on it, is down today. 100%. 100. I don't care what it is. It's down. Anything at or near a 52 is down today. It's tax loss harvesting. They're selling to wash away gains against other stocks they've made money on. So this is just one of those, again, year-end performance gaming will bid the 52-week highs higher. RCL, Royal Caribbean Cruises, whatever's at a 52-week high is going higher. And whenever's at a 52-week low, it's going lower. They're just going to revisit. That's what tax loss harvesting and performance gaming does. But I call it the Cyber Monday call, as in not a call, but a call option, because you have the Christmas cheer. You have to understand, this was so friggin' obvious they were going to run retail today. Like it was a given. You knew Amazon's going to be up. Did you have to even ask? Amazon's the beneficiary of Cyber Monday. So when you see a MACD on the way up at the RSI, in the Bierman model, in the Genesis COG, it's totally unshortable. Never, ever short indicators on the way up. It'll destroy your account, I promise you. You'll just get nothing but pain. Short on the way down, buy on the way up. That's the game. But if you want to sell on the way up, that's okay to take gains. Just don't short on the way up. So I just woke up. I'm like, well, Amazon's going to be up. Then Gap gets a upgrade. So they're going to run that up. But it's all Cyber Monday. It's anything that, oh, goodness gracious, TJ Maxx. Cyber Monday. Cyber Monday. You see where we're going with this? Anything at or near a 52-week high in retail is going higher, guaranteed. There's no stopping it. And any retail stock at or near a 52-week low is going lower. Okay, I guarantee it. I don't even have to look up. I'm not even looking at it. I don't even care because I've been doing this for 36 years. I'm the old man. I'm the Altacocker people at Theo. I've been around longer than these guys have. It's the same old, same old. 52-week high retail in Q4 goes up. 52-week low goes lower. Tax loss harvesting. I was at Target this weekend with my wife and kid. It's packed. Packed. The lines are out the door. Why is it down? Because nobody cares. They want to take the loss. They want to harvest the loss to buy Walmart. That's why. So Walmart made another higher high and then kind of ran out of gas. But it made a higher high. That's how the market works. Your money managers are closet performance gaming Momo traders. That's all they are. They don't do any research, so stop. They don't. I want to hire. They don't do any research. Stop. They just look at the chart and they go, is it going higher? I'm on it. Because they know they can't fight these algos. They can't do it. So the 52-week low retailers going lower and the 52-week highs are going higher. And that's the game. So retail is the one dimension carrying the market. But then again, it's not only retail. That's the Cyber Monday. It's also the mega caps getting loving today. Getting some loving. Get down on some loving. Did you all notice that Microsoft opened lower and is now up 7? Did you all know that Meta was open lower and is up 12? Your money managers woke up today and said, that's it. We're going to buy the Mag 7. That's it. It has nothing to do with Cyber Monday. It's irrelevant. It's window dressing. They're doing more of what's working and less of what's not. More money is coming in the market now than ever. This is the #1 Q4 funding in history. It's triple what it was last year. So money comes to a money manager. They can't sit around and go, They have to spend it. So they just buy the Mag 7. All Mag 7 should be up today. All of them. Look at them. Just go for it. I bet you they're all up. Not even look at them. Told you. I don't even have to look at the screen to know. Because it's just, it's all orchestrated. It all goes part and parcel with the script. It's manipulated. It's rigged. You should see this. So if you're like, I'm going to short Netflix, how's that working out for you? It's not working. Money managers walked in today and said 2 things. We're going to buy all the Mag 7. We're going to buy all 52 guy retail, sell everything else. That's exactly what they did. And for me, I'm positioned short financials. So to me, it's a great day. It's a great day for me because they're down, but they're not down a lot. They're not down enough to bring the market lower. But this market's being carried up 9 points. Tech, just the Mag 7, and retail. That's all it needs. That's all it needs to sit there and rotate in a circle and play. Doesn't have to go any higher. It's just not going to go any lower. So if you own the index, you might as well sell it because it's not going to go higher. But you can grab individual stocks and see if you can squeeze some alpha. The other third story of the day is currencies deflating. It's just deflating. So I woke up today and I'm like, oh, I looked in 3 o'clock in the morning. Bitcoin was already down 2,000. And then it got a bid and it went back up again. So they basically liquidated Bitcoin to buy something else. And then when it came back down, they bid it back up because it's a 52-week high. I keep telling you, anything at a 52-week high is going to be bought. I guarantee it. Guarantee it. Unless it's like some odd sector. And then, okay, they also had this morning down in currency. They also had gold down at one point, and that's rallied. That was down $42, and now it's down 14. So what they're trained to do is they're trained to say, okay, tax loss harvest the lows because they're crap. Get them out of the portfolio. Get them off the sheet. They're not financial porn. And just go buy these things. People, the days where I ran a hedge fund, where I actually sat and I was in the office 17 hours a day number crunching, those days are dead. The fundamentals are dead. They're not dead forever. They're just dead in this market right now. They don't matter. They never matter on the way up. They only matter on the way down. The last theme of the day, okay, catalyst, is time travel. And what I mean by that is, okay, anything that has to do with the future of transportation's up today. Tesla. Did you have to ask 50, even that's a MACD sell and it ran. Did it even matter? It's a MAG 7, so they had to buy it, right? And then you're going to get a little bit of Uber in there. Going to get some Uber pop in there, looking good there, right there. See that? And maybe you get a little bit of Lyft, the Lyft from Lyft. That didn't happen. That's interesting, but it's at a 52-week high, right? And then you can just go across the board and realize it's like, well, if there's is it cars? Is it driving? Is it the future? Is it EV? It's up. That's the themes of the day. It was just, they decided it's time travel, retail, and tech. Let's throw everything else out the window. So if you have anything at the 52-week low, sell it. They sold it. Whatever. Make up pick anything. Whatever's at a 52-week low, sell it. It's down. It's down. Doesn't matter. They're selling anything. That's just people. There's no fundamentals. And there's not going to be any fundamentals from now until December 31st. You can forget it. Just get rid of that crap. Just focus on the rotations and the tax loss harvesting and the performance gaming, and you'll figure out exactly what's going on. Come January 1st, it'll be a different story. It should be a different story. Last thing I want to throw out is this, okay? Part and parcel of I'm glad. By the way, there's 20 enrolled in my Genesis Cog Masterclass in January. I applaud all of you. Congratulations. Great choice, because I'm going to teach you how to stop making mistakes. Take a look at this, okay? Just follow the Bierman rules. It's simple. Is it on the way up? Then don't short it. How's that easy? How easy is that? Is this on the way up? Yup. Don't short it. Is it above the zero line? Yup. Hard short. Is the RSI on the way up? Yup. Don't short it. Is the K and the D up on the way up? Yup. 6 buy signals. I rest my case. Waste of time for me to short. Waste of time. Now, if you want to trade intraday and scalp with Corey and Tony, go for it, because the risk reward is so good you can't afford not to. But right now, if you're position trading, this is a nightmare for you. It's all manipulated higher. These money managers, if they could close the year right now and shut it down, they'd shut it down right at 5 minutes closing time. They would shut it down now to lock in 25% gain. And you and I know it. They know it. You know it. So just be aware of what's going on. If you're going to short on the way down. Like I'm on this. I'm finally in it. It's finally starting to marinate here. I've been in it since 57 and a quarter. Starting to come around. A little bit. It's going to take some time. It's a good short there. But I've covered, most of my shorts. I picked my spots. I went back in here, tagged this one again, tagged it there, covered, tagged it there, covered. I'm out, so I don't care. But I'm just trying to tell you, you cannot decide to short unless it's on the way down or break. That's it for you. So the S&P is not coming down, not likely today, not. So kind of get that out of your head. Now, without further ado, let's get into volatility, okay, and the S&P 500. And the program itself, as I mentioned earlier, and I'll use this, and we'll kind of go back and forth off this. And I'll be out there. I'm looking at Hashpipe. Hashpipe, do you live here? I love the fact I love Theo members who never leave. I really do. Peter Schrader, there's a lot of them. Okay, Rosita, she's out there. You'll see John Fleck. These people are here. They live here. It's like a warm family. It's good stuff. Tim is here all the time. There's Peter Schrader. Okay, so we're going to do part 2 of Esoteric Volatility Facts and Rules. This is good stuff for you to know, especially if you're an intraday trader, especially if you're a position trader, or especially if you're an investor. Because if you understand certain inimitable facts and patterns about volatility, you automatically have an edge. So I'm here to bring them to you. We're going to talk about stock market halts today. Stock market halts. I talked about what a halt is. It's a freeze. All trading activity is simply frozen. That's what it is. So there's different types of stock market halts. There are different ones. Okay. There are market-wide halts for stocks. There's asset-wide halt. They could actually halt crypto. They could halt bonds. They could halt ETFs. They could halt anything they want. So there's stock market halts. There's asset-wide halts, and then there's individual stock halts. Did you all know that? I'm sure you do know. I'm sure a lot of you know that. So I'm going to bring this to you. I'm going to bring this out there, okay, and show you today the circuit breaker halts. What's a circuit breaker halt? Well, it's all about volatility. And the reason why I bring this up is because not that I have prophetic foresight, because I don't, but I've been around a while. My hair's like falling out. My little daughter says my hair I got a little bald spot here, gray hair. People, I've seen a lot of, I see dead people. I've seen a lot of stress in my lifetime. This market is ridiculously stressful because it's not two-way, it's one-sided. And because of that, and because I've been around a long time, one-sided markets like this end in tragedy. They never end good. Two-sided markets never end in tragedy. Never. They go up, they come down, and they swing around. That's healthy. What you're witnessing is incredibly unhealthy. This is not healthy. So when the unwind starts, I want all of you to be prepared for it because there's going to be an unwind. My suspicion is we're going to have 1,000-point down Nasdaq day for sure. And we're definitely going to have a 500-point to 400-point down day. We're going to break all records in one day at some point in the next year or two. Because the downside of the market, when they unwind all of this nonsense, is there's no liquidity, so just free fall. And then the algos may or may not come in, and if they don't, it's going to get ugly. So here's what circuit breaker halts are about. Like, what is it? Okay. It's when they bring in what's called trading curves. And it completely halts and stops all trading of all U.S. stocks. No stock, Nasdaq, small cap, large cap, mid cap, you can forget. You're not trading. You might as well cancel your open orders because they're not, and I would immediately because you can't take a chance you have a stop. It wouldn't make a mistake. So it's when the benchmark indices, the S&P, the Dow, the Nasdaq, the Russell, okay, they fall below 7%. So the 7%, that's the threshold when the circuit breakers go on. And it's 7% below the previous day's closing price. That's the key, not the high price, the mid price, but the previous day's closing price between 9 a.m. Eastern Standard Time and 3:24 p.m. Eastern Standard Time. So you need to kind of be aware of this. I don't want any of you out there not aware of this because if you're not aware of this, okay, it's going to leave you in a bad lurch, okay? That's what's called level 1 circuit breaker. Level 2, okay, circuit breaker halts for 15 minutes. So the level 1 will stop for 15 minutes. Then it will reopen. But once it drops to 13% from the previous day, it's during the previous day's close. It's down 13%. So 13% from 6,000 would put it at about what? About 800 points. Let's say 800 points on the S&P. What would happen? Well, level 2 circuit breaker kicks in and halts trading for 15 minutes when the indices fall 13% the prior day's closing price between the market hours of 9:30 a.m. Eastern Standard Time to 3:24, that's the key number, p.m. Eastern Standard Time. Now, if benchmark indices reach the level 1 or level 2 circuit breaker price thresholds of 7 and 13% after 3:24 p.m. Eastern Standard Time, because remember, the market closes at 4 p.m. Eastern Standard Time. So you got that basically that 36-minute little window there, okay? Markets will continue to trade without a halt until 4 p.m. So they may actually reopen it up at 3:26 and go, it's closed for 15, let's reopen. And the next thing you know, okay, it moves forward. Oh, look, I have a stain. It moves forward and it's like, uh-oh. Next thing you know, the market does what? It keeps trading until 4 p.m. Level 3 is when things get really dicey. They get really serious. So like, hear this one out. Level 3 circuit breaker shuts down all trading for the remainder of the day. There's no like halt 15 minutes and let's reopen. Ain't going to happen. It's a complete shutdown for the day until 4 p.m. Eastern Standard Time. If the S&P index falls 20% below the previous day's close, do I think we're going to get a 20%? I do not. That goes back to 1987, where in one day the market was down 22%. That was the worst day ever in a single day on a percentage basis, but not necessarily on a point basis. I just want to point that out. So let's get that abundantly clear. It was down 22% in one day, but the all-time record has been eclipsed since then on by points, but not by percentage. But you're down 20%. Okay, that circuit breaker halt's going to kick in. You're done. You're not trading the rest of the day. How long will they close it for? Pardon me. I have no idea. Neither do you. Nobody does. They could during 9/11 they closed it down for what? I think they closed it down for like a week. It's hard to say. It's completely hard to say. We just don't know. Okay. Now, next on the agenda, for those of you who are really into Corey Rosenblum and really into Tony Rago, Mr. Las Vegas, okay, let me bring this to your attention. These are called futures halts. People didn't realize there are actually futures halts. There are, no joke. In after-hours trading, after hours, not cash hours, after hours, extended, the S&P 500, Nasdaq 100, and Dow Jones Industrial futures contracts trigger trading halts when they fall below 5%. It's called lock limit down. If it drops 5% in after hours, the futures close. Did you know that? Now you know that, okay? And they have what's called lock limit up. What's lock limit up? If the futures open up 5%, gap up 5% in after hours, immediately they shut, the market stops. It shuts. It'll stay right there. Lock limit up. They'll freeze right there because a lot of people are short and it could create a massive gamma squeeze higher and destroy people. So it's based upon their respective closing prices. So if the market closes at a certain level, opens up 5% futures after hours, it will freeze. A lot of people do not know that. People think of it as, well, it's explicitly stocks. That is not true. It's futures too. However, this still enables stocks and ETFs to continue trading in after hours. So even if the futures has lock limit up or lock limit down, stocks and ETFs will still trade in after hours. That's stuff you need to know because when we eventually get to this point, which I think we will in the next maybe few months, okay, you'll be ready for it. You're like, oh, I saw Bierman's program. Yes, you'll be ready for it. Here's another thing. The S&P 500, Nasdaq 100, and Dow Jones Industrial Average Exchange Traded Funds, the DGI ETFs, I think it's like DIA for the diamonds. Their trading prices can give a better indication of where the markets are going and where markets are trading, even when the futures are frozen. So here's the thing. If the futures freeze from lock limit up, don't freak out. Just go to the Qs, the SPX, or the diamonds, the SPY, and track them because those will actually move in real time and after hours, even if the futures are halted. A lot of people don't know this. Be aware, there's a lock limit up and a lock limit down. Okay, now you know. Okay, what about news halts? News halts? What's that? Okay, it means they're just going to freeze the market. The market shuts down. It's not going to work. News halts are pending on stocks, some individual stock, or it could be pending on an ETF, or it could be pending on an index, any one of the three. So they call them news halts. So what's a news halt? It pertains to what's called news pending, quote, news pending, and it's news pending related catalysts or events that can have a sharp and material impact on stock prices. These type of halts are usually requested directly from the underlying company in anticipation of potential price volatility in reaction to a pending announcement. So you need to be aware of news halts, and it happens actually more frequent than you think it does. Some of the more common events can be earnings related. For instance, for example, earnings guidance raises or cuts. That could be one. Corporate actions, for instance, like a CEO resignation or replacement, acquisitions and mergers, definitely going to move it. FDA drug approvals and FDA drug rejection, which destroyed some stock 90% the other day. Legal rulings and judgments, like a patent settlement, and or tender offers and solicitations, like Carl Icahn's doing his corporate radio job, right? So specifics can often be found on an 8K filing that often precedes the announcement. So be aware that there are news halts pending. And then once the halt is lifted, it will then resume trading after the news release comes out. News-related trading halts can last from anywhere from 15 minutes to overnight, depending on when the trading halt enacted and the types of news. So for example, a trading halt for a biotech stock, oh, that never happens, ahead of an FDA advisory panel vote, that could last an entire full day, okay? Whereas an earnings warning might only last 15 minutes until after the announcement comes out. So just be aware of news halts. I beg of you, you need to be aware. People, it's going to happen. TheoTRADE members, I promise you, it's going to happen at some point. It's the nature of the beast, people. This market's been up so long and so overbought for so long. It's bound to happen. It's just like what they say, like, it's the sample size. The more times you take a sample size, the probability it will come up, okay? Then you have what's called volatility faults. And a lot of people don't even know that there's volatility halts. Most people think there has to be news pending. There doesn't. There doesn't have to be news pending. There can just be volatility and the market can just stop trading, irrespective of news. So, pardon me. So what's a volatility halt? They're single stock circuit breaker halts that trigger 5-minute halts. They're 5 minutes on fast price spikes. We actually had that during COVID, or drops that exceed acceptable trading range prices, ATPR, acceptable trading range price, ATPR. For 15 seconds, they'll actually freeze the market. The ATPR is calculated as the average price of the previous 5-minute trading period. Just letting you let you know. So different stocks have different ATPR ranges. Volatility halts trigger when certain shares exceed 5% of the APTR for Tier 1 National Market System, the NMS, listed securities on the S&P 500 and Russell 2000 priced above $3 per share between, of course, 9:45 a.m. and 3:30 p.m. So it's not 3:24, but 3:30 p.m. Eastern Standard Time market hours, and 10% of the first 15 minutes and the last 25 minutes of market hours. People, it hasn't happened since 2020. It's been 4 long years. Now, obviously, COVID's in the rearview mirror. I don't care. You and I, Kaufman in the lamppost, we all know something's going to come up. Financial, geopolitical, could be the dollar, could be crypto. Something's going to come up. Buried deep underneath the surface. It's probably going to create some type of volatility. Get ready for volatility halts in this market. So if you're an intraday trader, it could be the death of you, or it could be the life of you. If you're on the wrong side, it could be the death of you. Knowing about volatility halts, I'm doing you a favor because I've known about this for a long time. I'm just sharing it with you because I feel like I want you to be a TheoTRADE member forever. So when it happens, you're not caught by surprise. You're like, yes, Bierman mentioned this. I'm prepared for it. Exactly. It's like World War III. So tier 2 stocks halt above 10% of the APTR between 9:45 a.m. Eastern Standard Time to 3:35 p.m. Eastern Standard Time, and 20% of ATPR in the first 15 minutes and the last 25 minutes of market hours. So the more volatile it gets, the longer the halt, okay? Other stock prices between 75 cents and $3 per shares, triggered volatility halt above 20% of APTR, blah, blah, blah. Those are just penny stocks, and I don't really advise on penny stocks. But if you get some wild volatility halts to the up or downside, you should be prepared for 5-minute halts for cooler heads to prevail so order flow can catch up, and also to make sure there's no goofing and spoofing or canceling bids and offers. One of those flash crashes, okay? The last one I want to bring out today is compliance halts. And people say, what's a compliance halt? Well, a compliance halt can be originated by regulatory bodies, including the Securities and Exchange Commission, the SEC, FINRA, which is Financial Industry Regulatory Authority, or the stock exchange itself, the New York Stock Exchange, the Amex, or the Nasdaq. At any time, if something's out of compliance, can halt trading. It happens, people. You're like, what happened? I'm losing so much money. You got to be prepared for stuff like this. Stocks can be halted for any number of non-compliant filing issues. For example, failure to file or a non-current 10Q, the quarterly report to the SEC, a delisting or request for more information on usual trading activity from the stock exchanges themselves. An SEC suspension, trading halt, can be devastating to shareholders, as the implication accusation of fraudulent activity could result in total loss of value of a stock and could create what? A forest fire of panic across the markets. It could create panic selling. So if the SEC starts to halt NVIDIA for lack of compliance, okay, it's a domino effect. It's a ripple effect. It could like scorched earth across all semis and all tech within minutes. If there's a compliance halt, be aware of these things. You're no longer going to be behind the 8 ball behind there. But again, what do you do if your stock is halted? Here's what is advised through the Nasdaq site. This is advice. It's not me telling you what to do. It's just an idea of how to handle it. If you happen to be in a stock that gets halted, the most important thing you can do is to stay calm. Don't panic, right? Volatility halts resume after 5 minutes, right? So, however, news or compliance halts can be more daunting situations. So the Nasdaq site itself offers a useful reference for confirming the type of trading halt your stock falls under, as well as having an up-to-date list of stock halts. So it also lists the time of the resumption, which will enable you to research and analyze charts to prepare for the reaction. You can do, Bollinger Bands, you can do standard deviation channels, you can gauge volatility far and wide. That's why you do it, okay? Speed is of the essence, right? When a stock halt resumes trading. Having a direct market access, a DMA, broker with multiple order routing capabilities like thinkorswim or whatever you have, it will give you an advantage over regular discount broker executions. You need to be able to get to different markets and not just be routed to one. Be aware of added volatility from potential margin calls, right? And forced liquidations. Having the control to perform instant executions directly through ECN limit books and bypassing market makers during chaotic activity, that can mean the difference between losing a toenail or a foot during the chaotic panic-driven action that follows upon trading resumption. So just be on top of that. Don't freak out, okay? But just be aware that it's out there for the taking. So that concludes stock market halts, and that took about a good 20 minutes. Just want to get through that. Okay, now, where are we going next? We're going to talk about historical volatility patterns in U.S. trading hours. That might take up the rest of the day, and the other ones are just 5-minute blurbs that'll take up most of tomorrow. It's 3 days. Okay, the question I'm going to ask all of you, and this is something that it's value added to a guy like Corey Rosenblum. It's also helpful for Tony Rago. Now, these guys presumably, don't listen to my program. It won't offend me, I promise you. But if they are listening, it's good to pass this along to your members, Tony and Corey. What time of the day is the most volatile in trading? And a lot of people don't know. Well, most traders assume the first and last hours of trading in any market, crypto, currency, bonds, stocks, commodities, gold, oil. Most think and assume that the first and last hour of trading in any market is the most volatile of the day. Not always true, but mostly in the first hour, the answer is yes, but not the last, and I'll show you. News from overnight trading needs to be discounted when the market opens. We know that, and during the last hour, funds and traders rebalance their portfolios. Remember, rebalancing is done in the first half hour and the last half hour. Those tend to be the bugaboo where if you're on the wrong side of the trade, you're screwed the rest of the day. You will find that out one way or another. Okay, and Corey is great at showing this in his sketches and schemes. Is it correct that the first and last hour is the most volatile of the day? Because that's what most traders assume. Well, again, I'm going to bring to light a white paper, an article that says the most volatile hour isn't what you think it is. So in stocks, the most volatile time of the day, on average, and that's the key word, on average, is the first hour. The first hour. So, you want to bring up the E-mini. Okay. I'll bring up the E-mini product here. Okay. And you're like, what about the first hour of the day? We'll bring up the first hour. Here's 5 minutes. Let me see if I can get this working. Okay. And here's the 5-minute chart. Get rid of my little line here. The market kicked open here, and now it's trading here. So we backed off a little bit, but usually the first half hour is the most volatile. On average, the least volatile time of the day is the last hour. That's a fact. History shows that. So in other markets, the most volatile time of the day varies. But when it comes to the stock market, write this down. Most volatile hour is the first 30 minutes. And for stocks, the least volatile is the last 30 minutes. It's a fact. So let me bring this to your attention, if I may, because I have this kind of printed out for you. Okay, we're going to go through different markets because I want to appeal and reach out, because some of you don't trade stocks. It's fine. Some of you trade crypto, some of you trade currency, some of you trade both, some of you trade bonds, some of you trade futures, some of you trade gold, some of you trade oil. It's good to know this, okay? It's a fact. Volatility measurement, U.S. trading hours, okay? The high price is the high-low price for each period is how they measure volatility, right? And it's divided by the day's opening price to get the average. So if you want to understand how an average is, it's high minus low divided into the opening price. Okay, I just want to throw that out. High minus low divided in opening price is how they get the average. Okay, so here's a fact. For U.S. stocks, the most volatile is the first hour. This is from white papers. These are time-tested studies. It's not like somebody just pulled it out of their head and watched it empirically. It's actually compiled data. The least volatile is the last hour. So let me bring to your attention something which is really, really, really cool. Okay? Really cool. You'll love this. If you've never seen this, it will change the way you operate. So again, look at the top up here. I'll shrink this down. Look at the top here where it says vol first hour, vol midday, first hour, sort of the first part of the midday, vol second part of midday, and then vol the last hour. So it's broken up into pieces. So it's 1 hour, like 2.5 hours, 2.5 hours, and 1 hour. That's how they're doing it. They're like breaking it up into 6.5 hours. You can see this. Now this, okay, is volatility, okay, during, and this was pulled out from 2020 to 2021. So this is 1 year's worth of data on an intraday basis, on an hourly basis. So it's 365 days, or what they would say 360 trading days, right? Working intraday. And this is really cool stuff. So what exactly does this data tell you? It says, now in this white paper study, they used the S&P as a proxy for the stock market and got the following volatility curves by using intraday data, okay, is what they did. So what does it mean? It means the most volatile time of the day is in the first hour of the day. That's the first hour. See that? Remember, this is going over a period of about 12, 13 months. That's the first hour. That's vol midday. That's vol second half of the midday. And that's vol in the last hour. See that? So the most volatility you get tends to be in the first hour of the day. Why do I bring this to your attention? Am I here to discourage you? I'm not here to discourage you. Are you out of your mind? I'm here to encourage you to trade. What I'm telling you is, if you're trading in that first half hour, okay, back off. Listen to Corey and Tony. Back away. Because if you get on the wrong side of heavy volatility in the first hour, you're not likely to be able to get out the rest of the day. Because volatility ebbs towards, this is like the last 10 minutes, and that's the last hour of the day. So it's telling you, if you're in it and you're on the wrong side, you're likely to be on the wrong side all day long. That's the lesson. This is why you come to Theo. This is why you pay me to tell you, if you're on the wrong side after the first hour, you're not likely to be able to get out. It's very rare. You can, but not on average you won't. That's the message. So the first trading hour day is the last trading hour of the day is the least volatile, and it should not come as a surprise to you. Just be aware. First hour of the day is most volatile. Last hour of the day is least volatile. That's why the graphic was there. Now, that's stocks. Let's not, okay, pour all our hopes and dreams into stocks. Don't do this. Let's talk about the Swiss franc. Let's talk about currency. Now, Blake trades currency. DePoche, okay, DePocher, Gianni Versace. These are Italian, beautiful, resident, handsome young man. He trades currency. So he should know this, or this might be good for him. The Swiss franc, and this is only the Swiss franc. It's not the yen. It's not the German mark. It's not the dollar. The Swiss franc, the most volatile part of the session, is not the first hour. Not like stocks. It's actually midday. It says 11:30 to 1:30 p.m. So that 2-hour window, it tends to be the most volatile for the Swiss franc. The last hour is the least volatile. So let me bring the data to you. This is really cool stuff. Like, I spent a lot of time doing this, and I'm absolutely proud to bring it to you. So this is the Swiss franc. Now, could you use it as a proxy for the Deutsche Mark, the Thai baht, the Japanese yen, the euro? Possibly. You could. But you see what's happening here. Like, this is the first hour. The blue is the first, 11:30 to 1:30, 1:30 to 3:30, and the last half hour is marked over here. You can see it. So the last hour of the day, that's the Swiss franc. Least volatility tends to be the last hour. The highest volatility tends to be midday. So even the first hour, most of the vol is not in the first hour. It can be, you can see right there. But most vol, if you're trying to take advantage of shorting or longing on a spike for a gamma squeeze or a reversal collapse, your best bet is to trade midday. If you're looking for volatility to trade a currency, first midday is the place to be. And if you get locked in here first midday, because the last hour is such poor volatility, it goes to my point. You're not likely to be able to get out. You're probably going to be stuck in that sucker. You're not getting out. So be aware, like, trade those 2 hours and then get out, because volatility itself settles in after that. Really cool stuff to know. Now, next on my agenda here, gold. Okay, I know a lot of you trade gold, and this is hopefully going to be helpful for you. This is all about volatility, okay? All about volatility. So for gold, the white papers, going back, they have shown that the most volatile hour is the first hour for gold, and that the least volatile is the last hour. So gold, okay, for more or less falls almost in line or in lockstep and correlates to volatility intraday for the S&P 500. So the first hour, lots of volatility. The last hour, virtually none. So once a pattern is established throughout the day, you begin to realize, like, oh, this pattern's been established. And then you have to kind of step back and realize, like, well, now that the pattern's been established, it's not likely to break. So you can't get cute. You can't be like, like thinking to yourself, well, I got locked in this pattern, I'm going to cross my fingers to get out. You're not likely to get out, because if the vol dies, it usually rolls into that. It just continually stays on that path the rest of the day. And even Corey points that out, and so does Tony. So the first day, mid-session is the most volatile, or the last hour is the least volatile. Now, what time of the day does it work out for gold? Here's the gold white paper. Open link in open image in a new tab. So let me bring this to you. Here's gold. This is really cool stuff I kind of stumbled upon. So again, first hour is this color. Blue is the first midday, meaning that 2-hour window. Here's another 2-hour window. And then over here is another kind of hour window. So you realize gold rarely is volatile midday. I mean, at midday, the last hour rarely gets volatile. Most of the time on average, look what happens to gold. But this is the last hour down where my cursor is. Volatility just dies. So what I'm telling you is, if you get into a gold trade and you're on the right side, okay, you're likely to stay on the right side most of the day. But if you're on the wrong side and you're hoping for a trapdoor to get out, it's not going to come, because you need volatility to reverse polarity. And this shows the last hour doesn't have much vol to it. The vol just dies. Here you can see the first hour is where most of the volatility is done for gold in that first hour. News comes out pending, it's released. The market then has to discount or reprice news, and there it goes. The first midday and vol second midday tend to trade in lockstep. So that first hour is the most volatile, the last hour is the least volatile. So if you're out there watching this program and you're an intraday trader for this is value added stuff, because you're going to realize, like, if you're going to place your bets to capture a swing intraday, it's going to be in that first hour. That's where it's going to come. It's going to swing up and stay there, or it's going to swing down and stay there. That's normal for gold. It's kind of like stocks. Just throwing this out there for your consumption. Okay, next on my list here of things to talk about. I'm going to pull this in. Okay, the last one is oil. Now, some of you, and my presumption is some of you, you're oil traders. Am I an oil trader? You might be an oil trader. Some of you might be oil traders. Some of you might not be oil traders. But nevertheless, I thought I'd bring it to you. Believe it or not, this is what this shows. I'm just the messenger. Okay. What about oil? Like, what does oil say? What's the most volatile time of the day when it comes to oil? Here it is. Okay. Open the image. Oil had me just stumped. I couldn't believe it. Now, the last hour of the day for oil definitely is the lowest volatility. But what it turns out for oil is it actually varies. And it's like, what? It actually varies. The last hour is the least volatile for oil, but the others are pretty much equal. Oil might be low vol midday, and you're like, well, it's done. And all of a sudden, midday it gets high vol. Or sometimes it's slow in the first hour, and then it just takes off. Sometimes vol just dies in the first hour. And this, again, was through July 2020 to August 2021. So this is like, about 13 months worth of data. And this goes to show you that, oil at any time of the day can explode in vol. So if you're a person who's like, well, I'm looking for action. You could only trade like currency and stocks in the first hour to get the vol play. Here, you can hang out all day long, and if no vol comes, it'll just come out of nowhere. The patterns on oil are far trickier to nail down than the patterns of any asset class. Oil is as likely to pop in the first hour, the second midday, or the beginning midday. Anytime. You see that. Look, oil is the most volatile of all of these, supply and demand, right? So what you see is that the regular trading session oil ends 1 hour before stocks, right? And it's expected that oil price is hardly moving after the stock market session ends. So again, you got to be aware of oil. To me, oil is what I call kind of like the wild card. So if any one of you are out there saying, I can trade oil, good luck, because oil is wonky. Only in the last half hour, or it will just die. But anytime during the day, it could be whack-a-mole for this product. Just want to throw that out there. So what time of the day is the most volatile in trading relating to all these products? All of them. Here's I'll bring up some oil today. Here's CL. What's going on? Not much is happening in CL today. Look, it popped and then it dropped. By the way, I hate to be a brown noser. I don't agree with a lot of what Gianni does, but I'm on board Gianni. I'm not touching oil. Oil's going lower. He and I, it's the only thing that I can see where he and I are on the same page. I believe oil is going lower. I think he's going to be right. I think I'm going to be right. But that's neither here nor there, okay? In stocks, for example, the most followed market on the planet, okay, we see that on average, the first trading hours, it's the most volatile, and the last hour, the least volatile. However, the Swiss franc, it's midday and not the first hour. So it's not a one-size-fits-all. It really isn't a one-size-fits-all. And when I checked, and I said, well, how did there were three guys who did this. How did they collect this data, and how did they curate it? Here's what they said. They used a U.S. official exchange trading hours, meaning 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time, or New York time. And thus, there were 6.5 hours of cash trading needs to be divided into sessions is what they did. So how did they divide the trading day into 4 parts? Well, there's the first hour of trading, which was 1 hour. Then there was the first midday session, which was the next 2 hours. That's 3 hours, 1 plus 2. Then the second midday session was 2.5 hours. So they extended that one. which makes it 5.5 hours. And then there's the last half hour. So it goes 1, 2, 2.5, 1, adding it all up, 6.5 cash hours. That's how they did it. So how did they test for the futures contracts and not ETFs? How did they do that one? Well, they did the S&P 500 contract. They did the Swiss franc contract in this study. They did the gold contract, and they did the what's called ETI futures contract. That's how they did it, a crude oil contract. So they chose these four because they're pretty different from each other and they have different attributes. So they wanted to get a sample size where there wasn't much what's called autocorrelation. Fancy word. I hate to scare the kids. Heteroscedasticity, or they wanted homoscedasticity. It's what they wanted. They didn't want all the data to be grouped together because it would have like negated the efficacy or proof of the pattern. So the S&P 500 and Swiss franc trade in Chicago, and the latter two, oil and gold, trade in New York. Okay, so they used 8:30 local time in Chicago and 9:30 local time in New York as the opening, and 1500 local in Chicago, which is 3 p.m., and 1600 local, which is New York, 4 p.m. So they did capture only 6.5 hours, and they made note that 2 of the asset classes were Chicago and 2 New York, okay? So how do these guys define volatility in their study? How do they define it? Well, they define volatility as the following. It's the rate at which the price of an underlying increases or decreases over a particular period. The rate, and not necessarily the magnitude. The more the price fluctuates, the more volatile the asset is. Volatility is often seen as a measure of risk expressed as standard deviation, right? And all of the financial theory is based on this assumption. But the evidence makes it clear that this is somewhat a faulty assumption. So for example, over the last 50 years, the worst group of stocks has been the most volatile, which has been the small cap stocks. According to theory, this should not be the case. But that is what backtests by Roger French reveal, and French and Fama. So that's Ken French, but Roger French revealed in his study. The legendary investor Warren Buffett has repeatedly said volatility to him is a poor measure of risk. That's what he says. Quite the opposite. We should take advantage of volatility, according to him. So Buffett says, don't shy away from volatility. Go ahead, Carol Ann, go into the light. Buffett says, reach for volatility, go for it, don't avoid it. I agree. Whenever I see low volatility, I immediately want to short it or buy it because it means to me that it's not normalized. To me, volatility is normalized and affords opportunity to make money in a counter move. That's how I see it. So again, they backtested and they found out that across all markets, right, and even all assets, most of the time, the first hour is the most volatile hour. The last hour is the least volatile. And then, of course, gold and oil will switch midday. This is stuff that you should put on your list and make note of this. Because if you're sitting there going, I got to meet my wife at the dentist, I got to go golfing, I want to go to the gym, take note of when volatility picks up. And once it dies down, head for the exits. Because at that point, you're waiting all day for something to occur that never occurs. How about the market? The volatility's dead. I told you the market's not likely to come down today. The advanced decline's worthless because it's all performance gaming. It's tech or bust. So I'm just kind of sitting here killing time, waiting for something to happen, and nothing's happening, which is really pissing me. But I'm actually going to start to build a short trade very soon when I get off here. I'm just waiting for it to pop. So again, this captures, okay, which time of the day is most volatile. Now, as far as tomorrow is concerned, we are going to go into these. This is kind of like it's kind of like a teaser. It's dessert. I'm giving you a little taste of tomorrow. We're going to talk about the 11 a.m. trading rule. We're going to talk about the 80% rule in position trading. These are all rules. They're facts and they're rules, which will help you, okay, figure out how to strategize, how to better trade either intraday, position trade, or investing. There's also an 80-20 rule in trading called the Pareto principle, which we're going to unearth tomorrow. We're going to unpack that and talk about that. We're going to talk about the best time of the day, not intraday, not within the day. Intra means within. Inter, which means day to day to day. What's the best week of the day to trade? What's the best week of the month to trade? And what's the best month to trade when it comes to volatility? Okay. And then we're going to talk about the 330 formula of the bank nifty. Ooh, real kind of esoteric, like cryptic stuff. Cool stuff. It's I'll make it very simple until I'll water it down. Keep it really clean. It's not fancy stuff. And then we'll talk about the 15-minute intraday trading rule. There's a 15-minute intraday trading rule. And then we'll close it out with the rule of 16 vis-a-vis volatility. These are actually like time-tested, standardized. They've been around for 50, 60, 100 years. Basically, almost all of these. And if you've never known them, now is as good a time to learn them. Because once volatility starts to kick up, not now. No, 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 no. No me gusta. No, it's not going to happen now. Next year, towards the end of the year, 2025, when they stop manipulating it, holding it up here, Atlas on the heavens, it is going to be, I think it's going to be probably the greatest volatility we're ever going to see in our lifetimes. Opportunistically, I think there are going to be 500-point swings down, 300-point up once we complete this year. The money managers are not going to let this down. They have to keep rigging this higher so they can get their fourth Ferrari. There's just no way it's coming down. I'm sorry, Don. I got to disagree with you. In the meantime, I'm going to turn this over to Gianni DePocci and let him run with it. This has been part 2 of, what's the title of my program? I forgot. Yeah, Prepare for Takeoff, Esoteric Volatility Facts and Rules, part 2. We will finish out part 3 tomorrow. On that note, I'm going to turn this over to Gianni and let him run with it. Have a great day, and I'll see you tomorrow. Hey, Gianni, take care.